Good morning, everybody. This is Live Trading Talk with Patrick MontesDeOca for July 29th, 2022. We're going to be taking a look at basically the reaction of the markets here after the Fed's announcement of raising interest rates 0.75 of a point. Some of the data is being delayed this morning. We have a couple of technical issues here in TradeStation. So bear with me here. It's been a pretty, it's been a pretty quiet opening here. We have a follow through here on the mini S&P at 36 points. $41.10 up 36.50. And we saw a little bit of a reversal, you might say, on the metals here this morning after a tremendous gain that we saw here yesterday. The new contract that we're trading is the December gold contract. It made a high here of 1785, 1784.60. At about 12 a.m. last night. And what you're looking at here basically is the standard deviation of the market, which is what the VCPMI identifies. It identifies basically the extreme standard deviation of speculation in the market and when we can expect a reversion to the mean to unfold. And so what you're looking at in terms of the charts right now, before we get into the fundamentals here for a minute, is that the market reached a sell one level of 1782, which was the one-to-one standard deviation level and target. And the VCPMI algorithm identified that from here we saw a short trigger unfold at about 1 a.m. and activated the targets below of 1774, which is the weekly sell-to level, and it has basically engaged now the weekly short trigger. So we have a combination of daily short signals and weekly short triggers that have activated the target of 1766. A little bit of profit taken this morning. We had a phenomenal rally in gold yesterday. And so a little bit of profit taken, I think, is appropriate. One of the things that I'm recommending here in the trading room for my traders on the trading floor basically is to trade from the long side. Trade from the long side. Trade into levels ideally that identify where the support, the accumulation of supply is. For the time being, the markets are a little bit overbought. Silver is holding pretty much its gains. It's made a high of 20.35.50 here last night at about 11:45 p.m. Most of the moves, the big moves, occur, it seems, on the Globex when the U.S. markets are closed and pretty much not too many people can take advantage of those markets or those moves. And also because the volume, the liquidity is very thin, so you can get a lot of big players to move the market all over the place like a wet rag. The NASDAQ continues to hold on to its gain, and what you see here basically is the market made a high of 12,948 as of last night, and we saw a little bit of a reversion unfold after completing the target of 12,774. Here again is the signal on NASDAQ at about 1:30 a.m. to go short. Came down, met the targets below, came down to the weekly standard deviation and reverted from there, completing the target again above of 12,908. $12,908 is a 38%, 38.2% Fibonacci retracement of this old big move from the high to the recent low that we saw last week. On the 16th of June, basically, the low was 11,068, and it came right into the, you can see the blue levels, which indicate the extreme standard deviation below the mean. And it reverted from there. And, you know, what I keep saying here is that when the price reaches the extreme levels of standard deviation below the mean, in blue, that is the highest probability area where you want to accumulate positions, where you want to build inventory, depending upon your profile. And you can see the market reverting from here, reverting back to the mean, and this is the reversion back to the mean principle that we apply as part of the algorithm, basically, that indicates very specifically when that potentially can happen and also tells you the trigger points. So on the other side of the coin, what you see here above the market is approaching red levels. And that is the opposite of accumulating. The red levels indicate basically that it is overbought. It's into an area where we can see distribution of supply. And as the targets are completed, the system basically goes neutral. So we're looking at weekly and daily targets above the market all the way up to about 13,273. So because the relationship, what we call a harmonic relationship between the weekly and the daily, is almost in the same area or at par, you might say, harmonically, we want to be careful up here, protect your profits below, and manage your situation according to your profile and your risk appetite and management. But what we have done here is we've lightened up quite a bit. We've taken some big profits here recently, and we pretty much are looking for some kind of a spike move into this area upon confirmation of a reversion or a reversal. We'll be looking to take some profits. I am not interested in going short in the market here, as basically what we have seen here with regards to the fundamentals. For example, if we talk about the Feds, yesterday, Jerome Powell confirmed that the Feds raised, or were going to raise, 0.75%, or 0.75 of a basis point on interest rates. And as a trader, basically what obviously I'm looking at is the reaction of the market, and also what the market is indicating. Outside of the news media publishing the data. And for that, we go to the 10-year note that basically traded below 0.75 of a point, and trading below 0.75 of a point puts the stock market, particularly the S&P, undervalued. I'm trying to see where the 10-year note is. The 10-year note is at 269, 269.25, and that is below 275. So we're looking at the stock market pretty supportive based on just the cost of money that we're looking at. And we've been indicating for the last few weeks to our traders here in Discord, basically, that we've been looking for some kind of a bottom confirmation. The fact of the matter is that when you take a look at interest rates, back in 2020, and this is a very critical point that I think a lot of there was not enough discussion of what's happened here with interest rates, except that we're beginning to see the repercussions of the velocity of this move that took place. That since March of 2020, basically, we have seen the 10-year note rise from 0.33% to 3.5%. And that pretty much was a phenomenal move in terms of the cost of money and the effect of basically everybody that borrowed here at these levels, literally free money. And all they had to do is just borrow money at literally very, very low interest rates and reinvest it in the stock market. And needless to say, that relationship worked until we saw the bond vigilantes, you might say, or the market itself revert from 0.33 all the way up to about 350%. This move here has caused a massive danger in the credit markets, particularly in third world debt. And anybody that was over leveraged in debt, as you can see, for example, in mortgage rates, that they have more than doubled in just the last few months. And so when we're dealing with this aberration or anomaly that I don't think we have yet seen the consequences, and we're going to begin to see a lot of defaults in bank defaults. Probably the European zone is in a state of chaos. The euro is at parity with the US dollar. Everybody's flying out of other currencies into the US dollar, and that doesn't necessarily mean that the US dollar is the strongest currency. It's a flight to safety in terms of currencies. But when you really take a look at the fundamentals here and the possibility that we might have another credit crisis developing here, it is unlikely that the Feds will raise interest rates on top of this tremendous pending debt that we have in the United States of about, close to or more than basically $30 trillion. And of course, the raising interest rates higher benefits central bankers. They are the ones that obviously are getting more interest on their money. But the Feds also have to pay more interest on their balances. So the velocity of interest rates that we have seen on the short end of the curve, the 2 and the 10-year note, has skewed pretty much the relationship of interest rates, and we have seen the yield curve invert. The 210, the 230, indicating the possibility that we might be going into a recession. And so there is no way under this environment, as a trader, I felt that the Feds are going to raise interest rates. In fact, the market already has discounted. If you hear the media talk about it, it's already discounted in the market. And what you have seen here is, even though there has been talk about raising interest rates up to a full point, the market hasn't collapsed in terms of stocks. So if you're a stock trader, I think you're looking at a situation where, ironically, it's contrary to this bearish fundamentals and actually very bullish for the stock market. Very bullish for stocks as we begin to see the market discounting this rise in interest rates and begin basically to deal with the possibility that the Feds may have to do a U-turn and get more dovish, you might say, as they say, which basically means keeping rates low and possibly having to not only lower interest rates down the road, but switch to printing more money and creating more stimulus. So as a trader, I believe that all of this talk, all of this hawkish talk is simply to control the market, manipulate the market, as you have seen since June of last year, when the Feds began to talk about tapering and when they began to talk about raising interest rates. We saw the top of commodities, we saw the top of metals, Bitcoin, virtual currencies had a massive, massive correction. Equities. So now, looking at the cost of money is indicating to me as a trader, and this is what I'm recommending my traders here, that the market is indicating that, or discounting already, even another 3/4 of a point in next meeting. But it would not be surprising that we see a lowering of interest rates or pausing, and that would just explode the markets. It would be very bearish for the dollar, which has been ripping, you might say, as a consequence of all this talk about rising interest rates to record levels. 106.42 on the dollar. So now when you really take a look at the monetary system, it is in a state of chaos. Currencies are in a state of chaos with all of this printing of money, all this stimulus that has been done. It has been basically imploding the purchasing power of all of these currencies. And even though the gold market has been manipulated, I believe that we're coming to a point where we're going to begin to place real value on what are real assets, based on basically the underlying inflation rate, the underlying currency, purchasing power. Let's come back to the markets here, and we're taking a pause here for a bit. We've taken some profits out of the market here, and I think for the next few days, pausing here for a little bit and give the market a chance to digest this rate increase. will identify for us basically the adjustment of the standard deviation program that we run, and look at some tremendous opportunities from the long side. I'm recommending to trade from the long side. The talk about raising interest rates has been discounted by the market, as you can see in the stock market, as you can see in the tech stocks. We're beginning to see money come back into the market, into those sectors, you might say, that have been battered, as I say, as a consequence of all this talk about rising interest rates. They have gotten the market to an extreme below standard deviation, and this has created tremendous trading opportunities, and this is what I'm pointing out to you. Trade from the long side. One of the things that we make a point and a policy for us here at the trading floor is to document pretty much everything that we do. And as of yesterday's, we closed out net profits of about 19,290 on swing trades. And even though we took some losses here, we ended the day, and the idea is that the net result is going to be profitable. So we've been buying this for our traders, recommending it for the last couple of weeks. And as of yesterday, as I said, we took some money off the table. We took some money off the table in gold, in silver, NASDAQ, and also we covered some hedges that we had in the market, basically by using dust against the precious metals. If you want to find out more, please join us here in our live trading room, our trading floor. We are giving a 2-week free trial. So click and subscribe, and we'll be more than glad to have you join us here and join our very successful community of traders. We're getting a signal here in the gold market as we end this session here, and I just want to take a couple of minutes here. If we close above 1751 here in just a couple of minutes here, would be the confirmation of a buy trigger. So be prepared, traders. A close above 1751 would activate a buy trigger, and we're going to be looking to enter the market here. So this is identifying a daily buy trigger by the market closing above 2-to-1 standard deviation above 1751. It includes the algorithm confirming the trigger point on the close above 1751. And we're going to be jumping into this trade. We're going to be buying 2 gold contracts at 1756.60. We're long 2 contracts, buy gold at the market for all my traders. Use maximum stop. Your target right away is 1780. Thank you once again, my friends, for the opportunity to share this tremendous information with you. And click like and subscribe. You will be amazed of this tremendous tool that we apply here in the trading floor. Have a great trading day. Have a great trading weekend.
Are you looking for an automated artificial intelligence trading system? Do you want to analyze commodities and financial markets to determine when to buy and sell? Looking for an indicator to predict future trends in the commodities and financial markets? Welcome to EMA2 Trade Live Signals. Our Variable Changing Price Momentum Indicator, VCPMI, is an automated AI trading system developed and tested over a decade. The VCPMI algorithm is based on age-old vortex mathematics combined with Fibonacci wave theory, trend analysis, pivot points, and several other widely accepted financial analytical methods. The VCPMI can help you take emotions out of your trading and rely on simple mathematics to predict future trends in financial markets. This approach will make your trading more effective, consistent, and profitable. VCPMI algorithm. The VCPMI code points and levels are support and resistance levels and behave exactly like any historical supply and demand level. Therefore, the VCPMI code levels are useful as an index tool for both day trading and for selecting and exercising entries and exits for longer-term traders. Why VCPMI? The VCPMI relies on artificial intelligence to analyze markets and predicts future movements, which seek to determine what a security or commodity is worth at a given point in time. The VCPMI uses technical analysis in the form of mean reversion trading, which seeks to capitalize on extreme changes in the pricing of a particular market based on the assumption that it will revert to its previous state. The VCPMI can be applied to both buying and selling, as it allows a trader to profit on unexpected upswings and save when security or commodity is trading at an abnormal level. Visit EMA2trade.com for more details. Are you looking for an automated artificial intelligence trading system? Do you want to analyze commodities and financial markets to determine when to buy and sell? Looking for an indicator to predict future trends in the commodities and financial markets? Welcome to EMA2 Trade Live Signals. Our Variable Changing Price Momentum Indicator, VCPMI, is an automated AI trading system developed and tested over a decade. The VCPMI algorithm is based on age-old vortex mathematics combined with Fibonacci wave theory, trend analysis, pivot points, and several other widely accepted financial analytical methods. The VCPMI can help you take emotions out of your trading and rely on simple mathematics to predict future trends in financial markets. This approach will make your trading more effective, consistent, and profitable. VCPMI algorithm. The VCPMI code points and levels are support and resistance levels and behave exactly like any historical supply and demand level. Therefore, the VCPMI code levels are useful as an index tool for both day trading and for selecting and exercising entries and exits for longer-term traders. Why VCPMI? The VCPMI relies on artificial intelligence to analyze markets and predicts future movements, which seek to determine what a security or commodity is worth at a given point in time. The VCPMI uses technical analysis in the form of mean reversion trading, which seeks to capitalize on extreme changes in the pricing of a particular market based on the assumption that it will revert to its previous state. The VCPMI can be applied to both buying and selling, as it allows a trader to profit on unexpected upswings and save when security or commodity is trading at an abnormal level. Visit ema2trade.com for more details.